Hello everyone, welcome to today's US Open live webinar. 10 minutes before Wall Street opens. As always, I'm your host Nikos Tsabouras, Senior Financial Editorial Writer at FXCM. We have a packed session as it has been an eventful couple of days since our last video. UK inflation decelerated significantly and leading to a GBP USD pullback. Meanwhile, the Aussie faces some difficulties despite strong labor data from Australia. Just earlier today, we had an increase in US jobless claims, which put some fresh pressure on the greenback and supports Wall Street, while Congress reached an agreement to avoid government shutdown. And we also had a positive undertone, a positive climate in the meeting, after the meeting between the US president and his Chinese counterpart. On the earnings front, British fashion designer Burberry disappointed and underscored the luxury market headwinds. So that is pretty much what most of what we will be talking about today. But before we begin, as always, please read carefully through the risk warnings and the disclaimers. Okay, let's get the ball rolling. We have quite a few things to talk about. We're going to start as usual with Euro USD, moving to the British pound and the impact of the UK inflation update. And then we're going to talk about the Aussie, which can't really benefit from the strong Australian employment data. Then we will talk about the Nasdaq, which consolidates its post PCI rally, and then also tackle Burberry's results, which underscored the soft luxury spending that we have seen from other fashion giants as well. So Euro USD showed some exhaustion after the post-US CPI advance, awaiting inflation figures from Eurozone on Friday. The bloc's inflation has decelerated sharply according to the preliminary data, and that could help the ECB refrain from further tightening after its pause and amidst economic hardships. However, today's US jobless claims showed the biggest increase since August, and that put some gave a new lift to the pair. The technicals have improved significantly after the best day of the year, and the common currency eyes 1.0959, but we still remain somewhat unconvinced around prolonged strength. There is scope for a fall back into the daily Ichimoku cloud, this pink region that you see on the chart, but an exit on the other side below the lower border that would make it vulnerable to the 2023 lows has a high degree of difficulty under current conditions. Onto the GBP USD, the pair jumped after Tuesday's inflation figures from the US, but erased some of those gains as the UK inflation report also showed deceleration. Headline inflation rose by 4.6% year over year, and the slowest pace in 2 years, while core CPI is to 5.7%. The news comes after 2 consecutive halts by the Bank of England and reinforces expectations for peak rates. Policymakers definitely have good reasons to stay on the sidelines since factory and service activity is suppressed, borrowing costs are elevated, money supply has been contracting, and the economy overall is in a poor state. On the other hand, inflation is still high and not expected to return below the 2% target for another 2 years. Now, GBP USD is having a good month, and the recent resurgence brings 1.2680 in the spotlight, but I'm still a bit cautious around its ascending prospects. The pair rejected the 38.2% Fibonacci of the July-October slump, and that keeps it in a precarious state. There is risk for a breach of the 200 period EMA at around 1.277, 1.274, although a catalyst would be required for that and for further losses towards 1.2036. Okay, let's transition now into the Aussie. Another pair that, of course, was boosted by the US inflation figures that enhance optimism that the Fed is done hiking, just after the Australian Central Bank had raised rates to 22-year highs following 4 straight meetings of inaction. Of course, we had talked extensively about that decision in previous sessions. More to it, this week's releases from Australia showed a notable acceleration in wage growth in Q3, which of course puts upwards pressure on inflation, and strong labour market with the additions of 55,000 jobs in October. Now, the Aussie has a chance to tackle the overhead resistance at 0.657, 0.6584, and then potentially look even higher, but does not inspire much confidence at this stage. As you can see, it struggles once again at the 0.65 handle. You can see essentially since late August, it has been rejecting that region multiple times. And it is unable to capitalize on the strong labor data, which are likely not enough to compel the RBA to more tightening. As such, there is still risk of sub 200 period EMA moves, but 0.6269 support seems distant under current conditions. And as the US session gets underway, let's transition to the Nasdaq 100. The tech-heavy index runs its 3rd straight profitable week and clinched new 2023 highs after the soft US inflation report. The deceleration raises the bar for further hikes by the Fed, and markets had never really embraced September's one more hike forecast. Expectations around the timing of the first cut were brought forward, with CME's Fed Watch tool assigning the highest probability of such action to May from June previously. More on the good news is a bipartisan agreement for a stopgap spending bill that will avert a government shutdown, if of course signed by President Biden, which will most likely, unless there's a major surprise, will obviously happen. Along with mostly solid tech earnings this season and renewed AI optimism, the index looks poised to reach new record highs. the black horizontal line that you see on the chart. But that could depend on NVIDIA's results next week, which has been the main driver behind the AI revolution. On the other hand, the rally does seem a bit stretched, and inflation remains high. Along with robust labor market and strong economy, there is risk for more tightening by the Fed, and in any case, the central bank reaches a prolonged restrictive stance. As such, a pullback towards the 200-period EMA seems reasonable. That would be a little above the 50,000 mark, and sustained weakness towards the October lows looks like, however, sustained weakness towards the October lows, a little over the 14K mark, looks like a tall order. Meanwhile, the meeting between Chinese President Xi and US President Biden appears to have lowered the temperature of the fraught Sino-Western relations, but it's hard to see any significant shifts in issues like the trade curbs around critical tech. Just today, Chinese tech giant Alibaba posted mostly underwhelming results and scrapped plans to spin off its cloud unit due to the uncertainties arising from the recent expansion of the US restrictions on export of advanced chips. So that is quite indicative of those issues between the two countries. And now let's transition to Burberry, the British icon and high-end fashion designer, which reported results today for the first half of fiscal 2024, the 6 months ended September, that is. Now, the luxury goods market is facing headwinds against an unfavorable environment of elevated inflation, high interest rates, and the faltering post-pandemic rebound in China, which is a bad weather for the sector and a key market for Burberry in particular. The British fashion designer reported a 10% increase in comparable sales during the first half that ended in September, but that was mostly due to strong performance in the first fiscal quarter, while China sales dropped 8% in the second fiscal quarter. Furthermore, citing the slowdown in luxury demand globally, Burberry said it's unlikely to meet its revenue guidance for the full fiscal 2024, and operating profits will only reach the low end of the guidance range. Other luxury giants have cited similar reasons and provided soft figures, such as Gucci owner Kering, who last month reported a 9% drop in sales in the third calendar quarter. Now, Burberry's stock, as you can see on the chart, sets around 9% today, and threatens the 2022 lows as markets reacted negatively to the results and the downgraded guidance. Of course, there are other factors in play. You can read a more in-depth analysis of Burberry's results in the FXCM analysis websites of your respective regions. Now, Burberry stock had a strong start to the year, and that culminated to April's record highs. But the second half is bad and runs its fourth losing month. On the other hand, the luxury market is generally quite resilient to the adverse macroeconomic environment, and there are in any case signs of improvement in those conditions. Furthermore, from a technical standpoint, the move looks a bit stretched, so we could see a recovery effort, but the upside looks rather unfriendly. And let's round things off with what's ahead as usual. Not that much going on. Tomorrow we expect the October Eurozone inflation figures. tomorrow on Friday. The preliminary readings showed a deceleration of 2.9% year-over-year, and that's the slowest pace since July 2021. So there is significant progress, at least according to the preliminary data, and this support the ECB's pause and reinforce prospects of peak rates. On the earnings front, we're going to have a chance to talk more about it, but we expect NVIDIA on Tuesday, the AI enabler, the Gen AI revolution enabler. And we also have quite a few Chinese firms have entered the spotlight, and we already touched a little bit on Alibaba's results. So that is it from me for today. We will talk again on Tuesday at our usual slot, 10 minutes before Wall Street opens. Thank you for joining me.